Hello, I'm Anthony Vokes, and with me today are Louise Lane and Julia Clark. We're all tax directors with Wright Vigar, and we're here today to talk about the budgets.
We know that Labour said in their manifesto promise they weren't going to raise taxes, and we've seen in the budget they have raised taxes, they've raised the rates of certain taxes, and we're going to talk about that later. But one important thing they haven't changed is that they've frozen the personal allowance, and that's the tax-free amount that you can earn each year without paying tax on. They've frozen the income tax and the national insurance thresholds. And the effect of this is that if your pay keeps going up year on year, hopefully it will a little bit, then you are paying more tax, even though they haven't increased the rate. So it's a stealth tax, isn't it?
Yes.
Yeah,
I was going to say the newspapers are all calling it a stealth tax, aren't they?
Yeah.
So these have actually been frozen for a few years already, and now they're going to be frozen for another 4 or 5 years. That's quite a big change, isn't it? Because it will mean that the value of what you were earning 5 years ago, hopefully you've had incremental changes over that period in line with inflation, and your tax bill actually at the end of it has gone up massively, and you're worse off.
But I feel sorry for the people sort of right at the bottom, because I understand about 700,000 more people will now be paying tax. So these are people who are, surviving on the sort of lowest amounts of reasonable level of income, if you know what I mean, and then they're going to come straight into the tax net.
Yeah, with the increase in the national minimum wage, etc., it will drag people who are in that sort of economy into the tax system.
We talked about there are some rate increases, and the main ones that you will have heard about already in the headlines are they've added 2% onto the rate for dividends, for property and for savings income. They're staggering it. They're starting with dividends from 5th of April 26, so April next year, that's coming in. They're going to add 2% onto the basic rate and the higher rate for dividend tax. They're not touching the additional rate, so that'll stay at the current rate, but we have a lot of clients that pay themselves through dividends from their own limited companies, don't we?
Yeah. I mean, the typical way that a lot of our SME clients would pay themselves would be by way of a fairly small payroll salary to keep up their NI record, and then the balance by way of dividend. And the tax system has kind of pushed everyone to do this over a long period, but they have been eroding the difference between the tax on NI and a salary versus the tax on a dividend over the years. And I'm interested to see where we are now, whether dividends are still more tax efficient or whether it's now salary.
We haven't seen anyone run the numbers yet, have we?
No, we haven't quite had time to do that yet, but it'll be something that we will probably do when we get back to the office.
Yeah, for sure. And then, so the year after, 5th of April 27, that's when they're bringing in the changes to the property and the savings income. They're carving that income out. So at the moment, property and savings will get taxed at the same rate as your employment income, etc., pension income. They're going to now have a separate rate for property and savings income, 2% higher than the main rate, so 22%, 42%, 47%.
This, of course, is where you were saying, they've said there aren't going to be any rate increases. But, income tax, we're saying, this is now property income tax, and we're putting an extra 2% on it, which, if that isn't an increase in the rate of income tax, I don't know what is, really.
Yeah, I mean, I don't remember there ever being a different rate of tax for property income and savings income going back to the start of my career.
Well, the Chancellor's logic was that you're not paying NIC, such as employees are, so it's only fair you should pay a bit of a higher rate of tax.
And they're not implementing this change until 2027, so it's a year later than the dividend change. I'm not really clear on why they've done that. And also, in this case, they are going to put 2% on the additional rate, whereas they're not doing it to dividends. Yeah. So it all seems slightly odd and disjointed. I'm not really sure why they've made those changes, and why they're doing it in this way.
I mean, they were definitely intending to tax what they felt to be passive income, weren't they? I know most landlords are not going to agree that rental income's passive, certainly the stories we've heard.
No, definitely not. And also business owners on their dividends, that's certainly not passive income either. It's going to affect an awful lot of our clients, the vast majority of our clients. So not a positive change for our client base, certainly. So moving to pensions, there have been some changes with regard to pensions, but perhaps not as bad as we feared.
Yeah, I think the main headline is that there are no major changes to the pension savings. There was a lot of speculation, a lot of rumour and a lot of fear that the amount you could put into a pension scheme was going to be reduced drastically from the current 60k.
There was even rumours about tackling the tax-free lump sum, wasn't there?
Yeah. Lots of clients really sort of scared and doing proactive pre-budget planning to make sure they've got the tax-free lump sum out before the budget. The only change they've made for pensions is quite a long time in the future. It's 2029, I think. Is that right?
Yes.
Yeah, 2029. And it's going to affect those who are making pension contributions via salary sacrifice. So instead of making a personal employee contribution out of your net pay, you would say to your employer, I'll have less salary. You make the pension contribution for me, make an employer contribution. That's tax-free. There's no benefit in kind or tax for employer contribution. But what it means is you're getting less pay and you're having to pay less tax and less national insurance on that. And what the government are bringing in, this new measure says if you sacrifice pay for pension contributions after 2029, if it's more than £2,000 you've sacrificed, there'll be no NI savings, the national insurance. So you can still sacrifice more than the 2,000 cap. And that can be beneficial for other reasons. You know, you might want to bring your adjusted net income down for certain metrics like the income level for childcare hours and things like that. So there might be good reason to put more in via salary sacrifice, but the NI savings are only going to apply up to that £2,000. So it's just going to make it more expensive to do so.
I think a lot of people are going to be really relieved that the pension schemes have been largely left alone, other than that change you've just outlined. As you said, a lot of people have been out doing pre-budget planning, taking their tax-free lump sum in case that goes. So I think a lot of people will be very relieved about the fact that there are no further significant changes to pensions. So turning to winter fuel payments, this is an area where the government have had some difficulties over the past year with a sort of turning direction, but it does now seem to be back.
Yeah, I think they've finally resolved what they're going to do with it, and it's not great news for pensioners. I think a lot of pensioners are going to be concerned about it. The £200 winter fuel payment, the next one that people get will be, imminent in the next few months. That is going to be clawed back if their income is over 35 grand in the tax year. So this tax year we're talking about, not future payments, not future tax years. If their income's more than 35 grand and they're not on qualifying benefits. So I think one of the most important one is pension credits that might get you out of the clawback. But so if your income's over 35 grand and you don't have pension credit or other benefits, you are going to get that £200 in your bank, but you're going to have to pay it back. There's about 2.2 million pensioners that are affected by this. 1.3 million, I think, are going to have the winter fuel payment paid back through Pay As You Earn. So this is typically, you've got a work pension, you've got a Pay As You Earn code that deducts tax each month on your work pension. They're going to do an add-on to that of £17 a month to claw back that £200 payment. The rub is that the Pay As You Earn system is sort of an arrears thing. It's a delay until it kicks in. So even though you're chargeable now on the winter fuel payment and next year, they're going to have to collect 2 years in one. So they're going to have £33 a month coming out of your monthly pay, which is quite a lot for pensioners.
That's quite substantial now, isn't it? £33 a month is quite a big hit for most pensioners.
Yeah. When it settles down, I think it's by 28, 29, it'll revert to the £17 a month, which is still not inconsiderable. If you're already in self-assessment, already file a tax return, then it won't be through the Pay As You Earn system. You'll deal with it on your tax return. We'll have to declare it when we're preparing them, and that will just be paid annually once a year back. There is an option to opt out of it if you know you're not going to be able to keep it and you don't want the hassle. I guess that's something you could consider.
Definitely, yeah. Moving on to changes to the Enterprise Investment Scheme and Venture Capital Trust Scheme.
Yeah, so this is quite a big change. For years, as long as I can remember, the income tax relief on investments in venture capital trust shares have been has been 30%, and they've reduced that now to 20%. So they're reducing those incentives for making these really quite risky investments.
So just to explain, a venture capital trust is you're investing in a basket of small startup companies. So still very risky, but probably a bit less risky than its sister, the EIS scheme, which is where you're investing in one company.
Yeah. They're not touching the EIS rate, so we're still going to get 30% income tax relief on investments in EIS companies, which, as you say, considered more risky. Yeah. And the CDIS, which are the really small startups, we're still getting 50% income tax relief on that. But a big change going down from 30 to 20. Also, a really positive change is that the criteria for companies that can take this investment, they're doubling all the limits, so you can have more gross assets. There's more money that can be put in each year, and there's bigger lifetime allowances, so that they are giving a little bit back. So we've just got a couple of other key changes that I thought it was worth mentioning. They don't really mash together as a subject, I would say, but we've got the minimum wage increases. Age 21 and over, that's going up 50p. Which is a 4.1% increase to £12.71. And for the younger workers from 18 to 20, they're getting an 8.5% increase. What is it they're going up to? £10.85? I think at that age I was working for £2.20 an hour.
You know, if you're an individual, when you're affected by it, obviously it's a massive positive, isn't it? But if you're a small business owner and essentially all of your staff are on the minimum wage, it's a massive increase. So, do you put it in the business tax and say it's all doom and gloom, or do you include it in the personal tax and go, woohoo, the rates have gone up?
So I think a lot of our clients will be concerned with this change. But clients who are in the hospitality trade, or maybe in the restaurant trade, hotels, they'll be very concerned about this. They're already running with very fine margins, and this is just going to make it worse. I
think it's on the back of the NI going up last year. That was such a blow, going up from 13.8 to 15% has affected so many employers, and they're still feeling the effect. And it doesn't stop with the employer, because those businesses are passing on the costs to their customers. So everyone's seeing the effect of that NI increase still. And this is just going to further compound it, I think.
Absolutely, I agree.
For some reason, the government think that we should limit the cash investments to 12 grand and
but you can put the difference, can't
into
you,
stocks and shares.
Into stocks and shares.
I don't understand, personally, I don't understand why we can't make our own investment decisions on how we want to make up that ISA, but the limit is going to stay the same at 20k, and it used to be flexible that you could choose how much was cash, how much was stocks and shares, but now they're saying the most you can put into cash is 12 grand and you can risk the rest.
Unless you're over 65.
Yeah, unless you're over 65, and they're saying no, you can put the whole lot in cash if you want to.
Yeah.
They do seem very keen for us to invest our money in the stock market as opposed to cash.
She gave some example, and I don't remember it, and she did stumble over it actually when she was giving the speech, but about if you'd been investing from day one in cash ISA versus in a stocks and shares ISA, and essentially she was trying to tell us you would be a lot wealthier had you invested in the stocks and shares ISA. But of course they're not, the reason the over 65s have the get out is because it's not guaranteed better return over a short term, is it? It's only over a longer term.
It's much more risky.
Yes.
It's liable to peaks and troughs. Over the long term, it will do better, should do better, but you can't guarantee that it will do better in the short term. It might tank next week. You just don't know with the stock market.
Yeah, I think this is a real controversial point, because for years there's been a real push on electric cars, trying to increase their adoption. We've had a lot of leaps and bounds in the infrastructure, able to go and get charging points throughout the country. So we've had a lot of tax benefits to try and incentivise electric cars, and then now we're really starting to see that adoption. They've hit us with a 3p a mile duty, effectively. A tax on the amount of miles you do. an electric car?
Yeah, so I think that's going to start from 2028, and I've yet to see how they're going to calculate how many miles you've done. So I'm a little bit uncertain about that.
Yeah, because you don't even need like an MOT for the first 3 years, because they used to always check the mileage and the MOT, didn't they? But
so it remains to be seen how they're going to gather that information. But yeah, I mean, I guess when you buy fuel at the petrol station, a substantial part of that is fuel duty, and they're not currently getting any duty on electric cars. Yeah, so an interesting change. Whether electric cars will remain as appealing going forward will remain to be seen.
we have a lot of people working from home now, especially post-COVID, if not fully working from home, some kind of hybrid working. And we've had a relaxation of the tax reliefs available, and without any question really at all, people have been able to claim a deduction of £6 a week against their employment income. So this is the situation where your employer doesn't give you anything at all for working from home, no reimbursement of those kind of expenses, but you can claim £6 a week against your income to sort of soften the blow and help meet those costs. But that tax relief is going to be totally removed going forwards.
And then the final point that you were going to discuss was regarding a further clampdown on fraud in the construction industry scheme, the CIS scheme.
Yeah, I think this is a really important point. They're just consulting on it at the moment, but it really shows that it's an area they're focused on. And we do have a lot of clients who are in the construction industry who operate CIS. And what they're really trying to do is clamp down on fraudulent businesses within the supplier chain. And there might be, several layers below where you are. But if you're a business operating the CIS scheme and you knowingly or should have known that you're transacting with a fraudulent business, then you will become responsible. They're going to take away your gross payment certificate, which means that all the payments you receive will now have tax deducted on them before you get the money. And it means that you can be held accountable for the actions of the others in your supply chain. So what it's really going to do is make CIS businesses do a lot more due diligence on the people they're paying and they're paid by, to make sure that there's nothing untoward going on.
So, turning to employee ownership trusts, there's been a big change to employee ownership trusts, and it's on the back of a big review that they undertook in 2024, which they did make a number of changes just to tighten some of the rules up. I'm quite surprised that they've come back for it and made some further changes. At the moment, prior to the budget, you could effectively sell your trading company to a trust that was that's owned by the employees, and you would get 100% tax relief, no capital gains tax at all. I think there's been a big, massive uptick in the number of these transactions that have been going through.
But you've been doing a lot yourself, haven't you?
Yeah, we've done a few as a firm. Yeah. I did have a slightly panicked email from a client this morning saying, "Are we okay?" His completed a couple of weeks ago. Right. Yeah. So we quite deliberately did it before the budget, but I didn't ever expect there to be a problem. It was just we were doing it out of caution. But yeah, that they've effectively halved the relief. So what was a complete exemption will now only be a 50% relief. So if you sell your business for £10 million, you would have previously paid no tax at all, and now you'll be paying tax on £5 million. I would imagine that business asset disposal relief will be available against the gain. But the balance of it will be taxed at the normal rate of 24%. Yeah. So a significant uptick in the amount of tax payable. I was quite shocked by this change. I don't know about you guys.
Do you think that's going to change whether people will go for it? Because I know that people were still, even with the 100% CGT relief, people were still not sure if it was the right route for them. And I think it's going to make it less attractive, clearly.
Yeah, moving to the John Lewis model is not without its complications, and you are kind of putting a slightly unwieldy structure in control of the company going forward. So I do think this will make it less attractive to people, and I think we'll see less of these transactions as a result. It remains to be seen. It's still It's still a good tax result. It's a lot better than the tax result you'll get from a trade sale, for instance, where you're paying tax on the whole of the proceeds. But it's not quite as attractive as it was, so I do wonder if this will mean that we see less of these transactions going forward. Now, turning to inheritance tax, this is a subject that has been very much in the press over the past year or so, since Budget 2024, when they announced big changes to the business property relief and agricultural property relief systems. Where there was previously 100% relief for agricultural and business assets, they've reduced that to £1 million at 100% relief, and then in excess of that, only 50% relief, which means that a lot of clients that maybe wouldn't have had an inheritance tax bill will now be facing a bill of 20%. So quite a substantial change. The farmers even yesterday were protesting on Whitehall. And there was a lot of rumours that the government might tweak the rules to kind of ease the transition a little bit, but they haven't done that. There was nothing in the budget about that yesterday. So despite huge opposition, particularly from farmers, the plan changes are going ahead, and they all apply from April 26. So big changes ahead for business owners and farmers.
I think the trouble with the farming thing is that they're very much asset rich and cash poor, aren't they? And so they're basically saying, well, we've got to sell off part of our farm in order to pay the inheritance tax. How is that going to benefit passing it down? Because inevitably over the years farms are getting bigger and bigger, aren't they? Not smaller and smaller. But if you're going to have to sell a little bit off to pay the inheritance tax each generation, it's not good news, is it?
So what this has done is it's encouraged the older generation to look at succession planning a little bit earlier, whereas the tax system before encouraged the older generation to keep hold of the land, stay as a partner in the business. Yeah. The new system seems to incentivise early succession planning, so we are seeing a lot of people passing land down the generations which they might not have done before. Mm-hmm. The younger generation being admitted as partners, people setting up family trusts. Once the new rules come in, we won't be able to use trusts in the same way. So anyone that's thinking about using a trust needs to do that in the next few months, and the clock is ticking.
Oh, that's good to know. So it's not too late. There's still something proactive that can be done.
There are still proactive steps that can be taken. It's not all doom and gloom. One thing that they did do that was a positive was that the £1 million allowance, previously they were saying it was non-transferable between spouses. So that has meant that we've been transferring land in between spouses to make sure that both of them are using their allowances. They've said that now will be transferable. So that is a welcome change. The inheritance tax threshold is frozen now at 325,000. They've frozen it up to 2030-31, and that will have been frozen since 2009-10. So it will have been frozen for in excess of 20 years, and over that period, inflation has roughly doubled, or will roughly double. So what was worth 325,000 back in 2009 is worth 160,000, 170,000 now. So a substantial stealth tax on freezing the allowance. Moving now to the Enterprise Management Incentive Scheme, the EMI scheme as it's normally known in the industry. This is a scheme that enables employers to provide share options to key employees in a tax-efficient way. The revenue are going to expand that scheme to allow larger companies to join. And roughly the limits are all going to be doubled, which will mean that bigger employers can offer these schemes to their employees. It does seem that with a lot of the venture capital schemes, the revenue are keen to make them more available by increasing the limits, and that's what they're doing here as well. So that is a welcome change. It will mean more employers can join the EMI scheme, which will benefit both them and their employees.
Because I think EMI is the most popular scheme, isn't it? When you're looking at all the different share schemes you could go for, everyone wants to go for the EMI because of the tax benefits. It's just usually the blocker is, do you meet the criteria? So
it's
relaxing,
the most generous
yeah,
one,
so
isn't it?
relaxing that is really going to help those people who couldn't access it before.
Yeah, definitely. Certainly in our marketplace, the SME market is the most popular one, and it's just a matter of meeting the conditions. Well, this will make the conditions easier to meet, hopefully. On the capital gains tax front, we were all very concerned that there could be increases to the rates of capital gains tax. It's been rumoured there's been rumours in the papers, etc., that they may do that. Well, there's actually been no changes to capital gains tax rates. So the main rate stays at 24%, and the business asset disposal relief rate is remaining at currently 14, going up to 18 from April. So that is welcome. A lot of transactions, a lot of trade sales and management buyouts, they've got them all through before the budget in order to make sure that they've got certainty of tax rates. Well, they do have certainty now, and we've got certainty after the budget as well. There's going to be no increase to the rates. There's also been a lot of people worrying about exit taxes for individuals leaving the UK. That we are seeing clients leaving the UK, unfortunately, due to the tax system, and they haven't introduced anything right now. So I think that it remains to be seen how many people do actually leave the UK as to whether they do anything, but right now they haven't.
I think if they'd have put the CGT rates up without introducing an exit tax, a lot of people would have left with their assets and decided to sell them when
they're overseas.
And not come back.
Yeah, indeed. Well, there is some positive news on business rates for the retail, hospitality and leisure sector. There will now be permanently lower business rates for those sectors, and it's going to be paid for by warehouses that are set up by online companies. So I think that seems like a very sensible change and very welcome for those sectors.
Yeah, I can't remember, but I think they said it's going to be warehouses or buildings with a value of more than 500k. So I don't know that it's going to be exclusively like your Amazon warehouses.
It's going to catch hotels as well, and supermarkets, larger supermarkets, that sort of thing, isn't it? But yeah.
So it's definitely something we're going to need more detail on, but it could be, something that affects these commercial landlords, certainly.
The corporation tax roadmap was introduced in last year's budget, and the idea was very much to give some certainty to businesses. This is what businesses are saying: will you stop footling around with our taxes and give us some certainty? Thank you. So there's been no increases in like the basic rates of your 19% and your 25%, but R&D is something that they've changed and changed and changed again over the years, with the most recent massive change being moving to this new merge scheme, so the SMEs have lost that really, really beneficial scheme that they had. But this time here, it's a bit of an administrative change. So you know how with groups of companies, when you do group relief, you can pay for it and that isn't taxed in itself. Mm-hmm. Well, this hadn't actually occurred to me because I haven't seen any of our clients do it, but you can surrender the repayable R&D credit to another group company, and what they're now saying is that that company can pay you for that, provided it's only up to the limit of the amount of credit that you've passed over. Mm. So, it is a positive thing within groups. Certainly where it's a very large group and they've got like different financial controllers, you go, why should I be giving you my relief? It's not doing my little group of companies any good. So this is a positive step forward, okay.
Tax relief for research and development, that is an area where it has had an awful lot of change over the past few years.
Oh, endless, yes.
Endless change. There was a lot of people out in the market who were making claims they perhaps shouldn't have been claiming. And as a result, the revenue have clamped down, and as is typical with HMRC, they've used the sledgehammer to crack a nut, and it's made the scheme much more difficult.
Yeah.
There's a lot more investigations than there used to be. They used to just wave all the claims through, not get a second glance, but now a lot of them are getting investigated in detail.
A lot more
before.
scrutiny, and I think they've got some sort of computer system, and there are certain things that are like a trigger point for an investigation. So, you know, they object to people making claims in respect of software if they're not actually a software company. And they did actually send an exploratory letter to one of ours, which is a highly R&D focused company, just because, you know, the word software engineer wasn't in their SIC code. So
the SIC code being the code on Companies House that describes your trade.
Absolutely, yes.
Yeah.
So capital allowances, I mean, that's another one where, you know, they've been in for absolutely years. They tinker with the rates, they give us a few extras. So basically what they're doing now is they're bringing in a 40% first year allowance. But the reason it's so exciting and different is because the so-called full expensing that they brought in for companies didn't apply to unincorporated businesses, and this does. So that's why it's very important. And the other thing is that when full expensing came in, they excluded assets that were for leasing, and that is not excluded with this. So there's still limits. There's still, you can't have it for cars, and you can't have it for overseas leasing. So there are still some exclusions. But, you know, at first it just looked like a really odd thing. So I've got 100% first year allowances on my main pool, and now you're giving me a 40% first year allowance as well. That's a bit odd. But they are slightly different. So that is important. And it's bringing the unincorporated businesses a 40% first year allowance, which they didn't have before, of course. So it's from January 2026, expenditure from there. And it's coupled with a reduction in the writing down allowance on your main pool. So again, this is something, it's actually seen a downward trend over the year. I'm so old, I remember 25% annual allowances, and then 20, and then 18. Now it's going down to 14%. But they're saying with all these upfront reliefs to encourage investment that, you know, in essence, because the writing down allowance, you get a fair bit at the beginning, but it actually takes a very long time to ever get full relief for an asset if you're stuck with them.
I think on 18% it took something crazy like 37 years, so goodness knows what it goes to now. Now it's 14%.
Absolutely.
So you are taking a long time to get relief for those investments.
Yes.
If you don't qualify for the annual allowance or the full expensing or the first year allowance.
I guess quite a lot of our clients will, if they buy a piece of plant and machinery, they will qualify for one of the 100% reliefs.
We have clients where they spend like millions and millions investing in kit and you know, big manufacturing clients and
builders that have a lot of heavy plant. Sometimes they use the million sort of, you know, no questions asked. So it's just one extra thing, isn't it? So it's a help. It's a boon. They're saying it's encouraging investment. So
yeah, but these big businesses, they're the ones that are the big employers, and you know, they're sustaining a lot of the local economy. So.
I was quite surprised at how much tax they said that the reduction to 14% would create. It was a big number. It was in the billions.
Yeah.
Yeah. So I was quite surprised at how big that number was.
So just on the zero emission cars, you were saying unfortunately there was going to be this 3 pence a mile charge, wasn't there? But there's still, for businesses, they're extending the 100% first year allowance. So that's zero emission cars and also charge points for electric cars. And that's being extended to March 2027.
Because they want everyone to get the electric cars so they can have the 3p a mile.
Absolutely.
So just to recap that, so if a business buys an electric car, they can still write off 100% of the cost on day one against their profits.
Yes,
so
and of course, you
relief.
see, that's in addition to your annual investment allowance, to your first year allowances that we've just discussed. So, yes. Now, corporation tax late filing penalties. Of course, we never send in late returns, do we? Absolutely. But it's been £100 as long as I can remember, and I think they're saying it goes back to like 1998 or something like that. And you've been talking a number of times in the course of these discussions about inflation and what a difference it's made. So in actual fact, that basic penalty is now going up to £200, and all the way down the line, those penalties are being doubled. So there was one, if you were over 3 months late, it was £200, it's now £400. And then if you were late sort of 3 years in a row, heaven forfend, that was going to be, that's £1,000, and it's going up to £2,000. So basically, this is when the filing date is on or after 1st of April 26. So again, coming in relatively soon. And finally, this is something that didn't really seem to fit in anywhere. I mean, I guess it mostly affects individuals, but it's the so-called mansion tax. Now, they were talking beforehand, weren't they, about the possibility of being a wealth tax or something like that, which I personally wouldn't agree with at all. And this is sort of a halfway house. It's not just taxing wealth, but it is taxing people who have a high value house. And I saw something in the paper this morning about, people in Richmond saying, I've only got a 1930s semi and I'm going to be caught by this, because it's an extra high value council tax surcharge. And if your property's worth over 2 million, you will pay £2,500 a year on top of your council tax. And then it sort of graduates up to, if your property's worth over 5 million, you pay £7,500 a year. So it's not inconsiderable at all, is it? Doesn't come in until April 2028, probably because they've got to get those valuations in place, haven't they? And it's homeowners, not occupiers, liable. So, if you have sort of a flat that you're renting out to somebody, generally speaking, they will pay the council tax. But in this instance, that surcharge is down to the owner of the property and not to the person that's living in it. So
another attack on landlords then.
So in the East Midlands, we probably, I don't know how many clients we would have that would have a house over 2 million. That there will be a few, but with our London client base, there will be a lot more people who are affected by this.
I mean, the price differences are just unbelievable sometimes, aren't they? Yes, it's going to catch quite a lot of people down there.
Well, thank you very much for watching and listening. I hope you found some of that illuminating. If you've got any queries, then please do contact any of us. We've also got a budget booklet which has more of the nitty-gritty if you're interested. So yeah, please do contact us with any queries, and we'd be pleased to hear from you. Thank you very much.